Welcome back to Investing Talk Podcast.
Today we are opening up the hood on a company that is arguably the most polarized battleground stock in the healthcare sector right now. We were talking about HIMS and HERS Health.
Oh, yeah.
And if you've been watching the headlines here in early 2026, you know exactly why. This is a company sitting right at the intersection of a massive growth opportunity and, well, a regulatory minefield.
It feels like every time I open a financial news app, there is a new headline about them, and it's rarely boring.
It is relentless. On one side, you have a business that has, managed to double its revenue in just 2 years. It's fundamentally reshaping how people access healthcare.
Right.
But on the other side, as we sit here on February 8, 2026, the volatility is palpable. The market doesn't quite know if this is the future of medicine or just a regulatory loophole that's about to close.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us and helps us keep digging into these companies for you.
Exactly. So Here is the big question, the hook for today. Is HIMS and HERS a telehealth giant that is currently on sale at $26 a share? Or is this a falling knife? A stock dropping so fast you'll get cut trying to catch it because it just got caught in the crosshairs regarding weight loss drugs.
Yeah.
Because the market signals are, they're incredibly mixed right now.
Okay, let's unpack this. We have to start with the baseline because the noise around the stock is loud, but the numbers, the hard numbers, they tell a very specific story. Let's look at the revenue trajectory first.
Yeah.
You have the data in front of you.
I do.
If you look at the last 12 months, or LTM, basically the total sales from late 2024 through late 2025, HIMS and HERS pulled in approximately $2 billion. $2 billion?
Yeah.
Just to give that context, that is double what they did in 2023, where they were sitting under the $1 billion mark. That is a velocity of scaling you rarely see outside of pure software plays. Usually when a company sells physical stuff, shipping pills and creams, they don't grow like a viral app.
And that is the misconception. People still think of this as just a website selling hair loss pills or generic Viagra. But the scale suggests something much stickier.
The recent performance backs that up. In Q3 of 2025 alone, revenue was nearly $600 million. That is up 49% year over year. And crucially, they aren't just burning cash to get there. We are looking at a net income of nearly $16 million and an adjusted EBITDA over $78 million.
Let's pause on adjusted EBITDA for a second. For those not staring at spreadsheets all day, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a proxy for the raw operational profitability.
Before all the accounting stuff.
Exactly, before the accountants and the taxman get involved. The fact that this is positive and growing while they are expanding revenue at 50% is the unicorn metric.
It is.
Usually you get high growth with massive losses, or you get low growth with profits. Getting both is very rare.
So they are profitable and they are growing at 50%. But how? Because selling generic pills, that just shouldn't yield those kinds of results.
That is where I want to jump in on a how.
Yeah.
Because doubling revenue to $2 billion doesn't happen by accident. It isn't just about selling pills. It is about the direct-to-consumer or DTC telehealth platform they've built.
You're arguing it's the platform, not the product.
Exactly. The product is the entry point.
Yeah.
You come for the hair loss treatment or the weight loss solution.
Right.
But the platform is the business.
Yeah.
They have been aggressively expanding care categories, moving into at-home testing, lab services, and locking people into recurring subscriptions. That is the key word, recurring.
The recurring revenue model.
Right. We call this the moat. In investing, a moat is a competitive advantage that is hard to cross. In traditional healthcare, the experience is, it's terrible.
It's awful, yeah.
You go to a doctor, you wait, you get a script, you drive to a pharmacy, you wait again. It's disjointed. HIMS creates high switching costs because of the personalized subscriptions and the recurring refill behavior. Once you are in the ecosystem and your treatment is auto-shipping to your door every month, you simply don't leave. This creates a network effect that protects them from incumbents.
It's the friction argument. They remove the friction. If it's easier to stay than to leave, you stay.
Precisely. And look at the margins. This is what allows them to defend that moat. The data highlights the gross margins are near 75%.
75%. For a company selling physical goods, that sounds like a software margin.
It is incredibly high. Most retailers are happy with 30 or 40%. But because HIMS and HERS owns the telehealth layer and vertically integrates the fulfillment, they capture a huge chunk of value.
Got it.
When your margins are that high, it allows you to moderate your marketing spend while still scaling fast. They have the cash to acquire customers because the customers are worth so much over time.
Speaking of cash, let's look at the financial health because growth is great, but solvency is better. The cash position is strong. LTM free cash flow is sitting at $189.4 million.
Which is a very healthy number for a company growing this fast. Free cash flow is basically the cash left over after paying the bills and capital expenditures. It's the real money in the bank that you can actually use.
It is. And if you look at the long-term projections, that free cash flow is projected to hit $502.5 million by 2030. That is entirely driven by that subscriber retention you mentioned.
And notice what they are doing with that cash.
Right.
They aren't paying dividends. They aren't doing massive buybacks yet.
Yeah.
They are reinvesting that free cash flow directly back into growth.
Yeah.
Specifically into things like labs and personalized fulfillment centers. They are building infrastructure, not just a brand.
Okay, so the engine is running hot. The fundamentals look cleaner than I expected, but the car is shaking a bit. Let's pivot to the charts.
The technicals. This is where the story gets complicated.
It's messy. Right now, the stock is in what technical analysts would call a volatile consolidation phase. It's hovering near $26 per share.
Right.
But you have to look at where it came from. In 2025, the stock suffered a 32% decline at one point.
That is a lot of pain for shareholders. A third of the value wiped out.
It is, and the volatility is still there. We are seeing daily moves of negative 3.77%. That is not a stable drift. That is choppy waters. There is high scrutiny on the options volume,
Yeah.
which tells me traders are betting on big swings, not a quiet ride.
I see that, but I would argue the stock looks oversold at these levels. You mentioned the decline, but despite that repricing, shares actually rose 34% overall in 2025.
So there's resilience there.
There's resilience. The stock took a hit, but the buyers stepped in. It's like a beach ball being held underwater. The
Yeah.
pressure is down, but the buoyancy is there.
So you see a floor here.
I do. If you look at the analyst models, TD Cowen has a target of $38. That implies a 43% upside from where we are sitting today at $26.
That is a significant gap. Usually the trading price and analyst targets are a little closer than that.
It creates a binary setup. Binary in investing means it goes big one way or the other, no middle ground.
Okay.
If the Q4 earnings, which are coming up, validate their 30% growth targets, the technicals position the stock for a breakout, we could be looking at higher highs very quickly because the stock has been coiled so tight in this consolidation zone.
Moving on to market mood. Because the charts are one thing, but the headlines are another.
And this is where we have to address the elephant in the room, or rather, the weight loss drug in the room.
The sentiment score. If we run a quantitative analysis on the news cycle right now, specifically from February 7th and 8th, 2026, the score is a flat neutral, 0.
Which feels generous, considering the headline.
Exactly. The news cycle is absolutely dominated by one story, HIMS and HERS dropping their compounded Wegovy plans.
This is the narrative shift we have been warning about. For a while, the glitter on this stock was the idea that they could offer cheaper, compounded versions of these weight loss miracle drugs known as GLP-1s.
Let's clarify that for the listener. GLP-1 agonists are the class of drugs like Ozempic and Wegovy. They suppress appetite. But they are expensive and often in shortage.
Right. And because they were in shortage, the FDA allowed compounding pharmacies to make their own versions, basically mixing the ingredients themselves to meet demand.
And HIMS jumped on it.
They jumped on this, offering a compounded version for way less money. But now the headlines are, HIMS and HERS drops plan for knockoff, and stops offering knockoff Wegovy pill.
That just sucks the air out of the room.
It does. The market mood is neutral to bearish in the short term, specifically because of this regulatory pullback on GLP-1 copycats. The market loves a growth story, and the cheap Wegovy story was a massive growth lever. Taking that off the table forces everyone to recalibrate.
And we are seeing that recalibration in the analyst actions. Just in early 2026, we've seen cuts. TD Cowen cut their target from $48 down to $37. Bank of America cut theirs to $29 with an underperform rating. That is essentially a sell signal.
Ouch. That Bank of America rating stings?
However, and this is the data checker in me speaking, the consensus still holds at $45.83. That is largely a hold rating, but the price target is significantly higher than the current trading price.
It's a dislocation. The analysts are cutting their targets to catch up with the sentiment, but the underlying valuation models suggest the stock is worth more. It's like the analysts are saying, the math says it's worth 45, but the vibes say 29.
What about the big money, institutional flow?
That's the interesting part. You noted there is no specific cluster buying from insiders in 2026 yet. No big Form 4 filings showing the CEOs backing up the truck and buying shares.
Which is usually a signal. If the CEO thought it was cheap, he'd be buying.
It implies institutional caution. They are waiting for the dust to settle on this regulatory news. However, the sentiment implies potential accumulation at this $26 valuation. The smart money might not be shouting about it, but they're likely nibbling at these levels because the core business outside of the weight loss drugs is still growing at 50%.
Let's look at the risks, because we can't ignore why the stock is down. We have to talk about the bear case.
And it really starts and ends with a regulatory risk regarding the GLP-1s.
Let's deep dive into this Wegovy issue. The event that triggered this latest drop was a combination of FDA restrictions and a lawsuit from Novo Nordisk.
Novo Nordisk being the maker of the original patented drug.
Right. They put the pressure on and HIMS buckled. They pulled the product. They had this $49 per month compounded product that was undercutting the brand name significantly.
Which was incredibly popular. I mean, $49 versus $1,000. That's not a hard choice for a consumer.
It was. And pulling it caused a 16% drop in the stock in after-hours trading. That is a violent reaction. The bear case is that this caps near-term revenue in the weight loss category.
Right.
If they can't sell the cheap stuff and they can't get enough of the brand name stuff because of supply constraints, that huge growth vertical just hits a brick wall.
That is a legitimate risk. But there are financial risks too, right? It's not just legal.
Absolutely. The skeptic in me looks at the balance sheet and sees a total debt-to-equity ratio of 1.92.
Almost 2 to 1.
Exactly. That is not low. They are leveraged. Leverage acts as a multiplier. It juices your returns when things go well, but it can crush you when growth slows.
Leverage works both ways.
It does. And then there's the valuation. The PE ratio price to earnings is 43.46 times. Even with the drop, this is not a cheap stock by traditional metrics.
No.
The S&P 500 average is usually around 20 or 25. So HIMS is trading at double the market average. It is priced for perfection.
We're at least priced for continued high growth.
Exactly. The danger is that if these investments they are making in labs and marketing delay profitability, or if the growth slows down because of the weight loss issue, the stock is at risk of severe downgrades. When you are trading at 43 times earnings, you cannot afford to miss. If you miss, you don't go down 5%, you go down 20%.
I hear that. And a 43x multiple is scary if you think they are done growing. But let me offer the speculative defense here, because markets are forward-looking mechanisms.
Go on, make the bull case against that risk.
There is a rumor check we need to acknowledge. There is speculation that HIMS is pivoting. Now that the FDA clarity is out basically saying, stop making the knockoffs, HIMS might pivot to approved channels or even M&A in the personalization space.
You mean buying their way out of the problem?
Yeah.
Or striking a deal with the big pharma companies?
Or innovating their way out. Think about it. The weight loss price wars are actually eroding big pharma's moats in a way. It's becoming a commodity. Eventually, that favors the distributor who owns the customer relationship, and that is HIMS. If the drug becomes cheap and ubiquitous in 5 years, the value shifts to the platform that makes it easiest to get. Who has the best app? Who has the fastest delivery?
Right.
That is the long-term bullish view on the regulatory mess. They lose the battle on compounding, but they win the war on distribution.
So you think the bad news might actually force them into a better long-term strategy?
I think it forces them to rely on their core strength, the user experience. They beat the traditional healthcare system, not because their pills were magic, but because their experience wasn't miserable. That advantage hasn't gone away.
It's a compelling argument, but it requires a lot of faith in management to execute that pivot seamlessly.
True, but remember, they started with hair loss, then ED, then dermatology. They have a history of successfully launching new verticals.
All right, let's wrap this up. We've looked at the massive revenue, the scary charts, the regulatory headaches, and the high valuation.
It's time for the verdict.
What are we watching next? What's the catalyst?
The catalyst is clear. We have Q4 earnings on February 23, 2026. That is just a couple of weeks away.
What is the expectation?
Consensus is eyeing a 30% plus growth confirmation. If they hit that, it proves the business works without the compounded Wegovy hype.
Yep.
If they miss that, well, look out below.
And the macro picture?
It helps. We are seeing a sector rotation into healthcare disruptors. Plus, rate cuts from the Fed are generally boosting growth stocks. Lower rates make that future cash flow we talked about worth more today. The wind is at their back, even if the regulatory environment is a headwind.
So, putting it all together, what is the score?
Taking the data and the context, we are giving this a bullish score of 8 out of 10.
8 out of 10. That is surprisingly high given the risks we just discussed.
It is aggressive. But here's the thesis. Despite the GLP-1 noise, which I believe is short-term, this is a company that dialed revenue to $2 billion with positive margins. You don't bet against that kind of execution easily. The platform is proving to be sticky.
And the valuation model backs that up.
It does. If you run a discounted cash flow, or DCF, analysis, it implies a 59.7% undervaluation at current price levels.
Explain DCF quickly for the listeners who might not be finance majors.
Sure, discounted cash flow is a way of estimating the value of an investment today, based on its projections of how much money it will generate in the future. We basically took those projected cash flows up to 2030, applied a discount rate to account for risk.
And the time value of money.
Right. And the math says the stock should be trading much higher than $26. The math suggests the panic selling has gone too far.
So, final verdict.
I'm calling this a multi-year hold. This isn't a trade for next week. If you buy this for a quick flip, you might get burned by volatility. This is a trade for the next 3 years. I'm targeting 21 to 29% annualized returns based on them executing on those 30% growth targets.
Meaning, if you can stomach the volatility, the potential payoff is there.
Exactly. The volatility is the price of admission for this kind of growth. If you want a safe, smooth ride, go buy a utility stock. If you want to get on the changing face of healthcare, you have to accept that the road is going to be bumpy.
That's the data. And a fascinating look at how regulation can clash with innovation. Make sure to subscribe, like, and comment to support the show. See you in the next one.